It's my pleasure with that to hand over to His Excellency Mr. Shehan Semasinghe, the Minister of Finance of Sri Lanka. The floor is yours.
Thank you. Excellencies, thank you for the opportunity to participate in this panel discussion and share with you Sri Lanka's experience on debt sustainability, which I am sure would provide you with the space to contemplate how gaps in the sovereign debt architecture can be addressed. Sovereign debt restructuring, as we all know, is a complex mechanism involving the national government, international creditors, and other stakeholders, principally the IMF. Sri Lanka is currently addressing an unsustainable debt and a balance of payment crisis which is having a negative impact on growth and on poverty alleviation. Growth and poverty reduction had slowed down in the last 5 years. A restrictive trade regime, weak investment climate, episodes of loose monetary policy, and an administered exchange rate of the capital amount which covers the administration of direct investment, foreign credit and debt securities, invest and capital transfers had contributed to external imbalances. Sustained fiscal disparities, driven primarily by low revenue collections, combined with tax cuts in 2019, had contributed to the high fiscal deficits, large gross financing needs, and a rapid growth of unsustainable debt. Sri Lanka lost access to international financial markets in 2020. After credit rating downgrades, the severe forex liquidity constraint was felt across the economy, particularly from the second quarter of 2022. Amid depleted reserves, Sri Lanka announced a mechanism of restructuring external debt in April 2022 and later appointed a legal and financial advisors to support debt restructuring. As you know, Sri Lanka is currently undergoing a debt restructuring process within a framework comprising of a special creditor coordinator committee co-chaired by Japan, India, and France. I'm also pleased to state that the co-chairs have extended an open invitation to all official creditors to join in this effort. We believe that this will lead to a successful debt restructuring process with the support of a multitude of stakeholders, including the official and commercial creditors. This is an opportune time for a country to be introspective about the question of debt and in particular debt structuring. The extended fund facility provided after negotiations with the IMF has provided us reasons of optimism. We are now in the process of assessing options in consultation with our bilateral and multilateral partners. We are aware about the concept of state contingent debt instruments, which reduces interest payments burden in recessions and provide fiscal space when a shock hits the economy. It's an instrument whose future payoff depend on future states of the world. It's used in structuring sovereign debt and its potential benefits in terms of debt sustainability that could emerge when sovereign debt is issued in state contingent GDP-linked bonds or longer maturities. In fact, a borrower, Sri Lanka, views favorably STDI-linked debt, given it allows the country to link its servicing or debt repayment to match the country's capacity to absorb such expenditures. We are aware that SCDI could be linked to GDP inflation or some such indicators. However, we are concerned about the level of uncertainty that such SCDI-linked instruments carry and therefore its appeal, or more specifically, the lack of appeal to fixed income investors. Our concerns stem from the rational thinking process where the cost of financing could be a reflection of the level of uncertainty that a lender carries. This could therefore mean that borrowing costs as reflected in the increased interest rates may in effect be inimical to the borrower, especially when such borrower is an emerging economy that really needs to minimize its cost of borrowing, especially when done in foreign currency. Cooperation and collaboration between countries, agencies such as central banks and such institutions will be important in creating an environment that mitigates the risks associated. At the same time, so as de-risk the SCDI-linked instruments, if multilateral partners and such agencies are willing to provide the collaterals back to such instruments, lenders will be more prone to invest in such instruments. Hence, the SCDI-linked instruments will require significant multilateral effort to be more popular. I have shared with you, in a summary, Sri Lanka's experience. However, with 54 countries facing debt distress, according to the UNDP, there is no one-size-fits-all model, and solutions have to be tailor-made to fit into each context. We have learned many lessons from the unprecedented crisis that we have gone through and believe this crisis presents an opportunity to regain economic stability with meaningful fiscal reforms and a renowned governance structure that would effectively address contemporary challenges. Therefore, it is time to take collective action to close long-standing gaps in sovereign debt and ensure reforms in the international financial architecture, allowing countries to have greater fiscal space, so as to ensure that vicious cycle of debt and default does not repeat itself. Thank you very much.
Thank you very much, Minister, for sharing Sri Lanka's experience. So my